Hi everyone, another little snippet on gold. The COMEX exchange trades, amongst other things, contracts for delivery of gold. It's often charged by gold bugs that the COMEX has more contracts promising gold than there is actual gold backing those contracts. The theory goes that one day, if enough contract holders demand delivery, those short the gold but not owning it will be forced to scramble for gold and the price will rocket. Well, I'd like to add a little meat of information to those bones of assumption. There's a fairly well substantiated story that a large banking interest has been forced to offer a substantial incentive to accept cash settlement instead of gold to a buyer on the London Metals Exchange who's hounding for delivery. Link in the box to the story, which is now appearing on Financial Sense. The point I'd like to make first is that many people seem shocked at this idea of a cash settlement instead of physical gold, because they're assuming that all the contracts are a promise for gold. This isn't the case. Let me continue. Anyway, is this the beginning for a gold bug prophecy? The breaking of COMEX. Well, this may seem oversimplistic, but the COMEX is a financial institution. That's important. It's at the heart of the US financial system, and gold, although much maligned as a barbarous relic, is still very much an influence upon international finance. The basic idea of most contracts traded on the COMEX is that person A promises to deliver an amount of physical gold to person B for an agreed price upon expiry of the contract. However, that is not the full picture. Many contracts are actually intended to be cash settled without any gold ever having to be delivered at all. These contracts have no relation to physical gold, and yet their trading has an effect upon the price of gold. Any arbitrage opportunity, any anomalies in price between the different contracts would soon be snapped up. So in other words, if someone's selling lots of the paper gold contracts, in other words the ones that aren't backed by a promise to deliver physical gold, that's still going to have an effect on the gold price. I'll give examples of those contracts later, but first here's my main point. I strongly suggest that COMEX gold contracts for physical delivery may well have an override clause written into them that can force a contract holder to accept financial settlement instead of physical gold delivery under certain circumstances of stress to the system, force majeure. Now I have to admit I couldn't find the actual data to back that up, but if someone can, I'd be extremely grateful. I just think that ultimately, if the whole thing collapsed, this is what I'm saying, and rather than it being these big banks scrabbling for gold, I think they would just go to the government. In other words, in the extreme event that COMEX was broken by demand for physical delivery suddenly outstripping the available physical gold, couldn't the COMEX, or those short the gold, simply declare cash settlement terms only in order to avoid physical default? And here comes the point I'd really like to make in the video. If demands for delivery of physical gold, which weren't available due to these shenanigans, if they did break the COMEX, the problem would become a problem not of delivery of gold, but a purely financial dilemma. Another financial meltdown. This time around gold, but just the same, a purely financial meltdown, easily solved, as we know, by throwing government money at the problem to make it go away. A bailout, to pay off the massive losses of paper gold shorted by the usual suspects, who are the same damn people that were bailed out last time anyway. Oh, and best of all, for the men behind the curtain, the inevitable scapegoat for this kind of malaise would once again be speculators creating a bubble, because to the ordinary people's view it would look like the gold price had gone berserk. This had created all kinds of problems as speculators jumped into the market, and again this needs to be now stopped and regulated. So this bubble, that they'd call it in gold, would burst, creating another financial mess, And of course more legislation could be imposed, providing an opportunity to sneak tough new measures upon gold trading. So in a nutshell, what I'm suggesting here is that ultimately this idea of breaking the COMEX and imagining people demanding delivery of physical gold and the poor old banks having to scrabble round and pay any price that's going for gold just to fulfill their contract, that may not be the case if they can get off the hook into financial settlement. As we know, the whole point of gold is that it's physical stuff. Once that gets translated into a purely financial settlement, it's just bits of paper again. Anyway, food for thought. Let me move on to those examples that I promised of cash-settled gold contracts. These are existing contracts which have nothing to do with delivery of physical gold, and I just wanted to mention them so that people are informed that these kind of contracts do exist. Very simple. The emini gold contract clearly states that cash settlement. Link to the contract web page is in the more info box, but let me read from the blurb. At 33 troy ounces for gold and 1,000 troy ounces for silver, these emini futures offer customers several important benefits, including 1. Direct exposure to the price of gold, silver with smaller contracts and lower risks to diversify your portfolio, and more importantly, number 2, cash settlement. There it is in black and white. This contract is settled in cash. Or how about the COMEX Asian Gold Futures contract, which is a cash settlement futures contract for gold. No delivery of physical gold is available. The contracts are designed to be settled in cash. Again, a link to a PDF is in the box, but let me read the final sentence, the final clause. 914.07, final settlement. Delivery under the contract shall be by cash settlement. The final settlement price will be the floating price calculated for each contract month. Final settlement will occur on the third to last business day of the month preceding the named contract month. So there you go. Thank you.